Welcome back, guys, to another roundtable. My name is Adam. I have Rusmin with me.
Hello.
And Victor.
Hi, everyone.
Thank you so much for joining us. And today at this roundtable, we're going to talk about US office REITs that are listed in Singapore.
Yep.
All right. And the interesting thing about them and why we're talking about them today is because they have very high yields at this point.
Yep.
Double-digit yields. So
Yep.
how high are they?
So Manulife US REIT is about 16.4% dividend yield. Then if you were to look at Pacific Oak, it's about 10.2%. And if you look at Prime, it's about 12.8%.
All right.
This is better than your SSB.
So yeah, I mean, we're so used to like single-digit yields
Yes.
for REITs in Singapore,
Yep.
And these are basically, I mean, the yields could change by the time. I mean, from the point of this recording,
Yes,
it could shift. But at this point, in double-digit yields, and you always can get the latest yields from sreit.fifthperson.com. If you want to check it out, we update that daily as well. But basically, the yields are so high, and I think the question would be, some people watching this is like, so do I? Because these are US REITs in a sense.
Yeah.
Listed in Singapore, but do I face the 30% withholding tax?
Yeah, I think that is not something that you'll be paying because of the way that they structure it. I mean, it can be quite technical on how they structure it, but in a nutshell, basically this the loans that they package it as a loan, okay, and this money is actually given out to the US entity, and then of course this US entity will then pay the interest back to the REITs itself, okay,
Alright.
and in the form of interest, okay, you don't really pay withholding tax for that, you know, if you're a non-US citizen, okay.
Alright.
That's why all the brokers always ask you to fill this form called W8 band form,
Yeah.
which you do it, you know, without questioning what is it. Actually, the purpose of it is exempt you from the tax.
Yeah, or to basically be clear about what your tax status is with regard to
Yep.
US
Yes.
assets and
Yeah.
all that. So just to be clear, these US REITs that are listed in Singapore, you don't pay the 30% withholding tax
So
because of the unique structure that they have.
Yeah.
All right. So maybe just a quick introduction of the three office REITs that we're looking at and what kind of assets they have.
Yeah, okay. First, let me start off with Manulife US REIT, okay, because they're the first that are listed in Singapore. Okay, they listed in 2016, and they own about 12 office assets in the United States. Okay, so two of them is considered trophy assets. Okay, and then two of them also considered Class B, and the rest of them is Class A. Okay, so let me explain what is Class A, Class B, or trophy assets is in the US, right? So for a trophy asset in the US, typically they are quite modern. Okay, and typically when you go into the building, you know that it's solid, right? You may need the access cards to enter the building, right?
Okay.
And sometimes you go to the building facade, you know, it looks very beautiful, right? Sometimes it could be a full glass panel, right? And you look at the quality, you know, is trophy, right? It's Class A, and typically they are located in the prime location, okay? And their tenants are typically big MNCs. I mean, these guys can afford higher rent, okay, and typically they command higher price because of the quality of the office that you're getting. And for Class A, it's very similar to trophy, except that they are slightly older, right? So if the tenants are also mostly MNC, they're also in the central location, okay, but could be slightly older as compared to trophy, because trophy generally considered less than 10 years old. Then they feature all the latest amenities, green building and stuff like that.
Okay.
And of course, Class B will be lower in terms of quality as compared to Class A, and in terms of location, it could be further out, right? So I mean, the best way to tell whether it's Class A, Class B, or trophy is just go to the toilet. Sometimes that's how I tell when I go to some of the office building in Singapore as well. Sometimes you go to certain office building, you go to the toilet, it's like Class B, okay. It's not very
It's
clean.
a good way to have a look at the quality.
And Class A, typically you look at it, got a tissue.
I don't mind sitting here.
Yeah, you mind sitting here for 30 minutes, an hour. Yeah, same thing for trophy itself.
The trophy will be like, oh my, this is better than my home.
Yes, it could be. Yeah. So and Class B, generally the tenants are SMEs lah. Okay. So what we have with Manulife is mostly trophy and Class A. Okay. They have two of them are Class B. Okay, but generally a tip-top type of property. Okay, and of course, if you go to Keppel Pacific Oak, I think they also, which is listed in 2017, the second oldest REITs, office REITs in Singapore. They are based in the US. Okay, so they have about 3 Class B, 1 mix, and 9 Class A. Okay, so I would say they are still majority Class A. Okay, and most of their offices are located in the key growth markets, like in the tech hubs of Seattle, Austin, and Denver. Right, so so these are that's for the Keppel Pacific Oak. Okay, and of course the third one is Prime US REITs. Also they are mostly 100% Class A office types. Okay, and they are more diversified in terms of geography in the US. Okay, they have 3 in California, 2 in Colorado, and a few of them in the East Coast. Right, and for Keppel Pacific Oak, they are all over. right, in the United States. And for the Manulife, they are mostly in the West Coast and the East Coast,
Okay.
right, in the US. Okay, so generally they are quite diversified. And one good thing about these REITs is that all of them are freehold.
Okay. Yes.
Right, you don't get that in Singapore,
Yeah.
right? Singapore office mostly 99 years leases, right? And yeah, if you look at their lease duration, also there's this lease that they sign with the tenants are mostly also quite long. Okay, and in Singapore you typically sign a lease structure of 3 to 5 years, sometimes 2 years, right? Unless it's a core tenant, you could sign a 5 years type leases. But in the US, you could sign as long as 15 years. And the beautiful part of all these leases is that they come with the rent built-in escalation, typically 2%, 2.5%. You know, and for this type of long leases, you come with a rent built-in escalation. It's very, very compelling to look at that.
So it's 2-3% per year, right?
Yeah, and it gives you that kind of perception that they are very stable because of the long-term leases that they have.
All right. So now we have an idea of the kind of assets that these US office REITs hold, in their cities and the quality and all that. So we have an idea of that. So now the question is, how come they seem to be pretty quality REITs in the sense that assets are quite quality.
Quality, yeah.
All
Class
right.
A, right?
Yeah. And then so the question is, how come, why are the yields so high? Like you said, well, was it 16%?
16.4%.
Yeah, for
Manulife.
Manulife, for example, that's really high. Why are they so high? Is it sustainable?
In fact, yeah. So in fact, before the pandemic, okay, because pandemic is the main reason why I think some of these REITs be traded so high. The office in the US, I think when they first listed, they are already giving you a potential yield of 7, 8, 9%, right? So it's quite high, okay? And what happened after that was, of course, you have pandemic in 2020 and things have changed, right? Even though now we have normalized, Americans are going back. I mean, things are going back to normal, okay? But the back to office is not back to normal, okay? It's the new norm, right? People are not going back to office in the US. Unlike Singapore, the physical occupancy for office, which the latest number that I get from CapitaLand is about 70%, and some buildings are already full, back to the pre-pandemic level. But in the US, they are still 50% or even lower. Okay, if I look at the latest stats by Castle, right? They back to work barometer. The latest number they have is about 45.6%. Okay, so it's still significantly below the pre-pandemic level, and this create a problem, right? And if your employees are not going back to the office, there is very little reason for the employers to rent that space, because most of them are working from home, right? And that caused some of the tenants to rationalize their space that they have in the leases they have with Prime or Manulife. Okay, and in fact, this is happening with Manulife. The top 2 tenants have actually indicated to them that the leases that they're going to expire, like the Queen, they are not going to renew it. Okay, basically, they're going to downsize it actually. Okay, so they're going to halve the space requirement that they used to rent. Basically, they halved it, and they renew with a lesser space. Okay, basically they are squeezing people together, but because not everyone coming back office all the time.
So just to bring it back a bit. So basically, this new hybrid remote work arrangement in the US looks like it's maybe here to stay. We don't know. Yeah. So you said 45% of the workforce is back in the office, which is actually not very high. Not very high.
It's still below pre-pandemic level. Before the pandemic, some Americans are already working on a hybrid work arrangement, and now it's
like normalized. This is normal to have this remote arrangement. So they're not coming back. So the leases are being downsized, and basically the REIT is earning less income.
Yeah. Yes, and also one of their tenants actually not intend to renew the lease also.
Yeah.
Okay. So which caused the valuation of the property to drop. Right?
Okay, yeah. Correct. Because the less rental income that the property makes, the lower the valuation.
Yeah. So if you look at Manulife, TCW contributed about 3.8% of their gross rental income, and this company have indicated that they're not going to renew the leases by the end of 2023. Okay, so that is going to be a big problem for Manulife. They need to quickly find the new tenants to fill out the space, and of course at this stage they're trying to do hotelization and stuff like that. Okay, but at this stage, what is happening, we are looking at the numbers, is that the occupancy have dropped quite substantially, right? So from before COVID it was about 96%, and now it's below 90%, 88%.
Actually, basically all the 3 office REITs are also below 90% right now, right? I think
except for Keppel Pacific Oak, I think they seems to have done quite well recently. They're still holding above 92%.
Okay.
Yeah. So I think the if you look at all the 3, the 2 most attractive one is actually if you look at Manulife REITs and also the Prime REITs. But if you were to look at their DPU, right, both of them actually dropped more than 10% on their DPU drop. I think which is precisely why they are trading at so high yield.
Okay, so the reason why, so I mean, we have to I need to bring it back a bit. So because the yield is high, because I mean the DPU is falling. So the only reason why the yield is high is because the unit price has come down. And the reason why the unit price has come down is because of all these challenges that you just listed. Basically, the macroeconomic factors, people not going back to work and stuff like that. And then the DPU falls, but then the share price has just come down so much. That's why the yield is so high.
Yep. I think Musk fallen the most by about 18.6%, mainly because they also reduced the payout ratio to 91%. Okay, they need to pay down their debt because on the debt gearing ratio is actually at 48.8% because of the lower valuation, and their gearing level just shot up to near to the regulatory level of 50%.
Okay.
Yeah, and for Prime also they have lost the tenants. Okay, so and although they telling us that the rest a positive rent reversion, but because of the low occupancy, that also affected their rental income. And of course, with the higher interest rate that now we are seeing across the board, there's more pressure on their rental income, and as a result, that affected their DPU. That's why we see DPU drop across the board. Prime drop about 12.2%, Musk drop about 18.6%, and Keppel Pacific Oak dropped mainly because of they decided to choose their management fee in cash rather than units.
Okay.
Right, and drop about 12.6%. Okay, if they say they were to continue to elect, compared to last year, they elect that in the form of cash instead of units, the DPU have dropped only 2.8%.
Okay.
So Keppel Pacific Oak seems to have done quite well as compared to the rest of the two. Yeah, where we see double-digit drop in terms of DPU.
Yeah. Yep. I think when it comes to yields, we have to be careful because a lot of some people could just see, wow, double-digit yields.
But they are double-digit for a reason, right?
Yeah, that's a good point. When something is like yielding so much, there has to be like a.
There's a reason why they are there, and it's our job to to look at them and see whether it's permanent or is it temporary. Right?
Correct. So I think that's the question right now because it's the yields are so high because prices have come down. It looks attractive at first glance, but when you look under the cover, and you see all these things,
multiple moving parts.
Yeah, so many things to consider. So I think a more long-term investor will go, okay, so it looks like there's an opportunity maybe for me to look at it because the yields are high, but the fundamentals don't look good. But is it temporary, like you said, or like eventually these things will iron out, normalize over the next few years? Office comes back, stuff like that.
For now, of course, if you look at the last 3 years, it's been very tough. Okay, because of the pandemic, the leasing activities is still below the pre-pandemic level. So you look at the latest data, they are still way below pandemic level. So the demand is still not there because of the new norm, right, of working behavior. So I think and plus recently, there's a lot of macroeconomic challenges. The companies have feeling a lot of pressure on the cost, so they are rationalizing on their rental income. Some tech companies are letting go of their space, and because of that actually leaves the whole office market in the US become in a very tough environment. Okay, the vacancy rate has gone up. Okay, if I look at the stats here, United States as of end of 2022, the whole office space in the US, CBD or suburban, I think they are looking at the total vacancy rate of about 19.6%. So that is really high. Okay, so if you're an office landlord, you know that this is a tenant's market, right? And although the rent per square foot is not falling, but if you look at because in the US it works slightly different, they do have tenants improvement incentives, and sometimes they give out free rent as high as could be a year if they sign a 10 years lease. Okay. So if you calculate the tenant incentives for them to do some renovation and stuff like that, by the time the net effective rent is still actually way below the pre-pandemic level.
So basically, what you're trying to say is that the supply is more than demand right now, right?
Yeah. So that is the problem with office. Every time, because there's very little differentiation when it comes to office, right? If you have class A, technically you can go to the other class A offices, if they can offer you a lower rent. Okay, but provided they are in the near same location. Okay, and that's why this sector is highly driven by the supply and demand, right? If there's oversupply, typically the market will tilt towards the tenants market. So it's very tough for the landlord to increase the rent generally.
So I think sometimes the thing about supply issue is that when there's limited supply, it's still okay, right? But when there's oversupply, sometimes it takes a long time to absorb, right? So I think based on history, how long do you think that the supply usually?
Yeah, so I think if you look at the last bubble, Lehman Brothers collapse, I think if you compare the occupancy level only, okay, which is what we are seeing is falling across the board, it took about 7-8 years for it to recover back to the pre-Lehman Brothers crisis level, right?
Okay.
I mean, of course, in some markets like Atlanta, it takes 7 to 8 years, right? And in some market like Orange County, right, it takes about same duration.
Okay.
Yeah.
So we're looking at about 7-8 years for this thing to kind of like normalize.
I mean, that's historical numbers that
historically.
you can benchmark on. Okay.
Yeah.
But at this stage now, there's still a lot of uncertainties in this sector.
All right.
Yeah, that's why the markets are pricing it lower.
Yeah, and there's so much space in the US. It's
Yes.
huge. And it's not like Hong Kong or Singapore where your offices are just like, this is what you have, too bad.
Yeah, and the offices in Singapore and Hong Kong, the vacancy rate, you're looking at low single digit.
Okay.
Right, 5%, 4%.
Yeah.
So these are the market that, of course, is tilted towards more on the landlord market where they can increase the rent.
Yeah.
Tenants will come to you because there's limited space, right?
Yeah, unless in the US you have this very key market like Manhattan, for example. It's kind of like different.
So that means the supply is limited. So the inflation and the interest rate does also help the landlord market, right? Compared to, I think that we actually mentioned during one of our video that when inflation go up, the rents actually went up, the REITs start to do well, but then on this case it actually goes the other way. Yeah, right?
Because the pandemic has disrupted the way how office works, right? And of course there is a oversupply situation, and then economy is not doing well. A lot of companies are facing a lot of pressure because they don't find the need to have office space anymore. Right, after the new behavior that shows up. Yeah, and there's the supply situation that is quite bad.
Right. Yeah. So basically, there's too much supply for the amount of demand in the US office market.
So what we're also trying to say is that even though it shows the data of the US REITs perform well during inflation, interest rate up, but at the end of the day, right, they jump up everything, all the REITs into one sector and they show the performance. But inside all those, there's also REITs that don't perform also. So this one thing that we need to take note.
All right. Yeah, I think there's research that we've shown in our previous roundtables, in our articles on our website as well. But basically, in an inflationary environment, REITs tend to do relatively well. Yeah. But in this case, for this US office sector, at this point in time, it seems that the new working arrangement and the oversupply has pushed the REITs downwards in this sense.
Yes. Yeah.
All right.
Yeah, and of course with the asset falling in prices, the gearing level looks very high now. Especially look at Manulife, 48.8%. Okay,
right.
So I think of course the question now is.
Yeah, so I mean, everyone watching this, they look at all the data and they're listening to our research and all that. Some of them will still go, so is this still an opportunity to have a look at it? Should I buy? Because the yields are so high and then eventually it could just correct itself, or, is it hard to avoid for you?
I mean, of course, this down cycle, we don't know how long it's going to last, right? Because now you're on the fourth year, right? We count 2020 as the first year, and now 2023 will be the fourth year that we are entering this down cycle for office REITs in the United States. And the new norms, I don't know, people are going back to the office unless the labor market is very bad in the US and the employers will have the bargaining power. Say, time to come back office, then everyone will have to go back. No choice. But because now the labor market is so tight, employees have the bargaining power. If you don't want, I will switch to other company, right? So that's something where I think there's uncertainty over there. And the second overhang is, of course, the interest rate. I think we are not seeing a low interest rate environment like we've seen in the last 10 years or 15 years, since the Lehman Brothers collapse. So this could be the new norm moving forward for office REITs. Okay, so the question is, of course, if you will decide to plunge in because of the valuation are so cheap right now, you want to stick with those that are financially very strong. Okay, I mean, MAS with gearing ratio of 48.8%, it doesn't look attractive to me at all. Okay, right, but Keppel Pacific Oak with gearing ratio of 38.2% only, I think looks in a much more stronger position with interest coverage ratio of 4 times and the weighted average maturity of 3.6 years. Looks a safer bet to me. If let's say I see this as there will be a way out. I think once the economy bounce back, the next 3 years inflation comes down, interest rates start to stabilize. It could be this could be a good bet. I will go for those REITs with a stronger position, right? Prime, their gearing ratio is about 42.1%. Okay, and weighted average term to maturity is slightly shorter as compared to Keppel Pacific Oak, right? At about 2 years. Okay, so so among 3, Keppel Pacific Oak seems to stand out, but we have not seen their tenants moving out yet. Okay. So I think maybe because they are in the key growth market in the US. Okay, so but in terms of valuations, all of them are very attractive. They are they're at a historical low. Okay, if we compare to the COVID level. Yeah. But again, the risk is quite high.
Yeah.
Right?
So I think they are traded at very low price to book valuation right now. Right. But I think one thing you also need to take note that if you were to look at Manulife REITs, right, if you look at their book value has been decreasing. I think since like 2017, right, was at 83 cents book value, but right now it's like 57 cents. So there's a decrease in book value, even though the price to book is very low. So generally, the Pacific Oak and the Prime, their book value seems to be much more stable compared to Manulife.
Yeah. So again, this is provided if you are confident that office REITs will pick up. Okay, personally, I would not go for them, even though the prices are so attractive, because I still believe in investing in REITs that can gives you, quality type of earnings, dividends, and of course the book value have continued to appreciate. But yeah, this is just not in the criteria that we set out in the Dividend Machine, which we just launched recently.
So basically, even at these prices, you would say, no, this is not something that I would look at. So again, not a recommendation to buy or sell anything. This is just our opinion and what we, the research that we're found out about these US REITs. So basically, you have to pick the right kind of REITs
and then stay with them long term.
So valuation is just one part of the equation. So this is what we do in dividendmachines.com. If you're interested to learn how to invest in REITs and dividend stocks that give you a passive income from your portfolio, do check out dividendmachines.com/YouTube. We open this once a year, and in this case, even though it's so cheap, valuations are so low, you still avoid these US REITs at this point in time. Because the DPU doesn't look like it's going to go up. And you could suffer some capital losses as well. And you don't know, some people don't want to ride through that.
And if you look at Manulife, you don't know what's the base. Even though you buy right now, the very attractive book value, if the book value continue to drop, the book value per share continue to drop, then it's not attractive as what you seems is attractive, right?
All right. Yeah. So some of these things are just out of control for the REITs, as well as macroeconomic factors and all that. Yeah, so I think that will be your opinion at this point in time. Yeah. All right, so that's pretty much it for the US REITs. Yeah, so I think it's a pretty good wrap up, right, guys? All right, so my name is Adam. That is Rusmin. That's Victor.
Thank you.
Thank you so much for joining us. I hope you like this discussion about US office REITs. We do a lot of research on REITs almost every week, every month, every year. We are looking at that all the time, and we teach our students how to invest and pick the best REITs in Singapore, Hong Kong, Malaysia, for their own portfolio. All right, so if you're interested in that and you want to find out more how you can invest for dividends, do check out dividendmachines.com/YouTube. We open that once a year. If you watch our roundtables, we hardly talk about our courses because we only open them once a year. So do check it out if you're interested. All right, so with that, thank you so much for watching. If you have any questions about US office REITs, put them in the comment section. We'd love to answer your questions. Subscribe to our channel. Many more roundtables coming up. If you like this roundtable, hit the like button. And thank you so much for watching.